Welcome to the Catholic Economics Podcast. I'm your host, Levi Russell, and today is August 15th, 2020. So today I want to go through a bunch of economic data, macro data, and kind of give a preview for what I'm going to be doing in the future here. So I'm going to be doing 2 shows a week. One will be focused on this kind of thing, economic news, economic data, and then the other will be focused on the stuff that I've normally been doing, which is policy and the application of Catholic social teaching and things like that. So I thought what I would do is put together a bunch of charts and stuff like that and just kind of go through and discuss kind of my thoughts on some of this information. And so this is just a chart. So Fred, I love Fred. Fred's a great resource. So it kind of is a way to aggregate. It's a source for aggregation for all kinds of data from a lot of different government sources. And it puts it into these nice charts. So this first one is GDP because I wanted to kind of get just a general overview of what's been happening recently. And so the thing about GDP, I think, the recently, if you've been paying attention to this kind of thing, the last 2 quarters have been, the quarters that have dealt with the affliction, as my friend Anthony Stein puts it. I don't want to get in trouble with YouTube, so I'm not going to be using the other terms. I'll just use affliction. So, Q1 GDP. If we measure GDP on a per capita basis, first quarter GDP dropped just under 1%. And then this quarter, or this most recent quarter, second quarter data came out I think a week or 2 ago, and we saw a drop of almost 10%. And if you look at GDP growth on just a national basis, not on a per capita basis, it fell something like 34%, I think. So obviously we know what's causing all of this. We know that the drop in activity and the drop in purchases is what created this. And so the first thing you need to know is what GDP actually is. So GDP is the final value of all goods and services produced in the economy over a certain period of time. And by final value, what I mean is we subtract off the intermediate value, right? So if we're producing a coffee mug, then the GDP associated with that coffee mug is just that final product value. We don't count all the transactions that happened in the raw material stages and stuff like that. So GDP has its flaws, and in a future episode I want to talk about this other measure called gross output that does count all of the stages of production. So I think that's a useful measure sometimes. But GDP is the one that everybody talks about. And of course, we've seen this big drop in GDP. And really, I think the important thing here is to explain this the most important thing to explain, I think, at this point with GDP is the divergence between GDP numbers and the stock market. And so obviously we've seen the stock market just absolutely going crazy, and obviously with having some dips as well. But the stock market is an asset market, whereas GDP is a measure of changes in basically what we call national income. So, the stock market is measuring the value of companies, the value of the companies that are listed on the exchange specifically. So it's not intended to be a broad measure because it's not measuring anything about activity for firms that aren't listed on those exchanges. And so I think whenever we see a divide, a big divergence between growth, especially this extreme of a drop in growth, while we see asset markets going positive big time, I think one way to explain that, especially in the current context, is just simply to say that, look, this is a transfer of wealth from Main Street to Wall Street. This is an indication of the massive destruction of small businesses around the country. And I think I've seen some surveys showing that 22% of them at least will never come back. People have just given up. And that capital associated with those businesses, right, it's being reorganized, right? So the I guess libertarian type defense of this would be, well, that money's just going to get invested somehow, some other way, right? And it's like, yeah, it is going to get invested some other way, and all of the and all of that capital is just going to go, well, not all of it, but that 22% from those businesses, right, that aren't going to come back, a lot of that capital is going to end up in the hands of the largest, most powerful corporations. And so it's just going to increase their power and control over society. So, this has been a massive windfall for guys like Jeff Bezos, who run these large corporations. And so I don't want to get into stock market valuation models. I mean, there's a simple model where you just look at, the asset value is a function of future earnings and the interest rate. But I think the general story here, the obvious take, is that this whole affliction has really, really the policy response to the affliction itself actually has driven capital out of the hands of the Main Street business and into the hands of these larger businesses. I want to look at industrial production. So I kind of, the way I've set this up is just kind of starting with GDP, starting with the big picture, and then breaking down into smaller things. And if you're listening to this on the podcast, I'm going to, on the audio, I'm going to do my best to just kind of explain what's happening. So you don't have to see the visuals, but if you're on YouTube, I'm going to make sure this is up on the visuals for you. So the industrial production index is a normal measure we've used for a long time to look at industrial production in the U.S. And of course, just to get this out of the way, and we're always treated to, whenever people like us complain about manufacturing jobs leaving the country, et cetera, that gets kind of translated into a slogan like, America doesn't make anything anymore. And then, of course, the opponents of this view then point out, oh, well, industrial production is up, way over what it used to be. It's like, yeah, but it's all being done by robots. So, industrial production, and it's kind of interesting to see how we had a huge drop in industrial production. I mean, getting us back to the point where we were in, say, January of 2010. So this index in April of 2020 was as low as it was in January of 2010. So in a way, you could say that it sort of wiped out about a decade of industrial production capacity, right? Well, not industrial production capacity, excuse me. It wiped out about a decade of industrial production, at least in the short term there. And we've seen it bounce back. And I think what's interesting is, it certainly hasn't bounced back to where it used to be. And I think in the most recent months, so March and April really hit retail super hard, I think. And now I think what we're seeing, at least in some of these numbers, there's some indication that retail has recovered, not completely. Obviously, a lot of these small businesses that are just gone forever are retail businesses, small town retail. But what we're seeing, I think, is a lot of these ripple effects back through the supply chains of all these products. And of the things that we need, food and stuff like this. I think we're seeing these ripple effects coming back through, and we're starting to see, I think, more economic issues that are fundamental to the system. That you can make the argument that the affliction response just uncovered problems that existed already, but you can also, I think, make the case that the policy itself is what did this. So sure, there's the argument out there that that Americans need to be less materialistic and we need to buy things less. Yeah, I agree with all of that. But the people who make those things also need to be able to make a living, and so it's it is a concern. So another thing to point out here is that it's kind of interesting how we were kind of sliding down here from 2015 into 2016 and kind of flattening out with this industrial production index, and then we kind of get this surge in industrial production index starting in 2017, late 16 in 2017, and I think part of that might be just a response to Trump's promises, and I think delivery in some ways of more pro-America industrial type policies. For instance, just refusing to sign the TPP way back at the very end of 2016, early 2017. So people can talk about the fact that they don't like Trump because he's not doing everything that they want him to do, but my goodness, just not signing the TPP was massive. Okay, so let's flip to the initial claims number. So this initial claims is jobless claims, and so you can see, obviously, back a few months ago in March, this spiked from kind of the normal number, which is right around 200,000, a little more than 200,000. It's kind of been the normal number for the last 5-6 years, and then we have this massive increase at the end of March of 6.8 million jobless claims, initial claims. So this is like, people, I'm unemployed today. Like today, I'm coming into the unemployment office because I have lost my job. And so this is, this isn't how many people are unemployed. This is the jobless claim. This is the initial claim of being out of work. So we had this big spike, and for a couple of weeks here, 3.3 million March 21st, and then March 28th to 6.8 million, and then it starts to tail off a little bit. And this past week, we were expecting. So, just to give a little background. Normally, when we're talking about these economics numbers for these big indexes and stuff like this, or these big series like initial claims and stuff, we often have some expectation of what those numbers are going to be, right? We have analysts and all these financial institutions that are trying to predict what that number is going to be. And then we sort of are treated to this binary response. If the average expectation was 10 and we come in at 8, then sort of the markets and policymakers will react to that. Okay, well, was that we got 8 instead of 10? Is that good or bad? I mean, why is it? Why were the predictions off and all of this? And in this particular case, I believe the average was something like the average prediction was something like 1.4 million initial claims, and instead we got 963,000. So of course that's bad. Of course 963,000 is still 3 or 4 times 4 or 5 times what we normally get for jobless claims in a normal week. But the fact that we were well below the average prediction, I think potentially that shows us that some of these policies are working. Some of the PPP loans from the CARES Act, essentially Trump bucks for businesses, some of that might be working in the sense that people are coming back to work. I think potentially there is there's some effect from the expiration of the unemployment bonus dollars. So the CARES Act gave us an extra $600 a week for anyone who was unemployed from the federal government. And because that expired at the end of July, I think maybe there's a little bit more hiring activity going on. And so maybe that's why part of the reason why we saw this drop in initial claims. So related to that, obviously, is the unemployment rate, and we have seen the unemployment rate come down. Nothing too exciting because we're still above the unemployment rate in 2009, 2010. We're still doing worse than then. And I'm gonna dig into some more labor stuff, but the overall unemployment rate has come down. And again, I think part of this is just because the PPP has worked in the sense that it's injected a lot of liquidity into a lot of Main Street businesses, and of course we don't want those PPP grants and loans going to larger businesses like Amazon or whatever. But hey, I guess sometimes in policy, we're taking the good with the bad, and at least the good is, small town USA or whatever, or small business. Labor force participation rate. So labor force unemployment statistics are kind of confusing until how they're calculated. So the labor force participation rate is the percentage of people that are in what's called the labor force. So in other words, they're either working now or they are searching for work. Okay. So those two groups of people make up the labor force. They make up the labor force. The labor force participation rate says, okay, how many people are either working or looking for work as a percentage of the total population over a certain age? And I believe it's either 16 or 18, something like that. And so you can see labor force participation obviously is going to drop right after sort of the affliction response, right? Somewhat of a drop in March and then a huge drop in April. And so this is where you have to sort of be careful about looking at unemployment rate statistics, because the unemployment rate is really calculated off of the labor force, not off of the total population. So the labor force is the denominator in the unemployment calculation. So we have seen a bounce back and then a little bit of a tailing off of labor force participation rate. It bounced back, I don't know, about a third of where it had dropped to. So in February of this year, we were at 63.4% labor force participation. So 63.4% of the more or less adult population of the U.S. was either working or looking for work. And what's interesting about this series, I think, is looking at it prior to right now. The labor force participation rate declined during and after the Great Recession and did nothing but decline after that. So this is, back in 2010, 11, 12, we were talking about the Obama policies and all of these people being added to the food assistance roles and all of this type of thing. And so labor force participation rate has done nothing but decline until sort of flattening out in 14, 15 range. And then again, it started to tick up after Trump was elected and after he got put in office. I think so. You kind of look here in 19. There's a little bit of a potential here for it to start rising again, and then boom, the affliction and the policy response hits, and now we're dropping off a cliff in labor force participation. So from a Catholic social teaching angle, obviously we don't like the idea that everybody's just a wagey or whatever, but at the same time we do want to recognize the dignity of work. We want people to work for the things that are going to sustain them. And so on that topic, I split this out into some of the age ranges and stuff. So the labor force participation rate for what we call the prime age. Okay, so these are, I'm trying to give you some glossary in this. The prime age is 25 to 54 years when we're talking about labor statistics. And so obviously that age range is going to be a lot higher overall percentage participation, right? So those people between the ages of 25 and 54 who are either working or looking for work as a percentage of the total population between the ages of 25 and 54. So we have been as high as 80% or 83%. And again, we can see this trend. Things started to tick up a little bit during 16, right? So at the end of the Obama administration, but Trump was able to kind of just continue that rise to very strong levels. I mean, if we look at this historically, just and pull this back even to the 80s. Uh, Obviously, labor force participation during the 90s and stuff like this was higher than it is now. But you can see on this graph that the Great Recession was horrible for this particular index. So labor force participation among prime age, right, among people who we would think would be working, right, by the time you're 25, you should be kind of starting to sort of build your pater familias, right? You should be able to be out there, kind of hope, ideally, right, building your life on your own, and up until age 54, maybe after that you're gonna retire early or something like that, or maybe by that point you're injured and you aren't able to work anymore. But during that time period, 25 to 54, again, is that prime age, and we saw that just did nothing but drop, kind of, well, kind of in line with the unemployment rate, uh, for several years after the Great Recession. Then it flattens out and starts to get a little more positive, and we're back to, well, before the affliction policy anyway, we were back to, you know things we saw kind of during the Great Recession, before there was really a response to the Great Recession itself in terms of this index. So I think, potentially seeing some green shoots. We at least bounced back off of that low in April, and things have improved a little bit. And we're starting to see things drop again in July. I'm not really sure what's going on there, um, but it's going to be an interesting thing to watch. So I wanted to continue this sort of labor force discussion. So this is I don't know why they call this the activity rate, but it's sort of like, the labor force participation rate. But in this case, I've broken it down for males in the prime age range, right? So these are like people we would expect to be, working and sort of, again, building that family life. And again, we see a similar trend here, kind of things starting to improve in 2016, coming out of the very long, Great Recession. Things starting to improve and then continuing to improve after 2017, and then again with the affliction just dropping off a cliff. And so again, this index was in February. It was at 89%, 89.3%, of prime age males in the U.S. Were sort of part of that labor force. So again, this index has been much higher in the past, but for different reasons. But I think, again, this is some interesting green shoots here, and I think it's good to see those. But I'm a little concerned because, GDP, we're just now seeing, I think, how bad the GDP numbers are going to be, and I think next quarter, we'll probably officially be in a recession because, we'll probably have another negative growth number for quarter three. As much as, and I'm not a macroeconomist, I'm not an expert in all of this. This isn't my area, but I guess I know enough to at least do some interpretation of the statistics here, kind of on a basic level. But I'm not going to be building fancy models or anything. Labor force participation among men in general, again, same pattern. We were at 69.3% in February, and we've dropped off to 67 recently. Now this is another this is something interesting I wanted to share. So we kind of see over the short term here a similar kind of trend for women, prime age women. And again, prime age in terms of the labor force is 25 to 54 range. And we can see it just in general labor force participation for women. The same kind of trend here where, again, declining after the Great Recession and then starting to build back, although at completely different numbers. So the labor force participation for women was at 57.8% in February, whereas for men, it was at 69.3. So it's much different in terms of overall levels. But once you dig back in time here a little bit, so let's go back to 1970, you can see kind of women starting to enter the workforce here in the 70s and stuff like this. And so labor force participation among women just climbing rapidly through the 70s and 80s. And into the 90s, really, and kind of peaking out in the early 2000s, kind of with the numbers for men and the overall numbers. But this reminds me of something my doctor said to me the other day. I was in for a checkup, and she said, the U.S. started to have problems with obesity around the time when women started entering the workforce. And so you have, this is right around the same time we get the idea of hamburger helper and these sort of instant kind of bread-based, pasta-based meals. So it was kind of interesting to have your doctor make a statement like that. But I think, again, this is it a bad thing that labor force participation among women is going down? I mean, that's dependent on your perspective, I guess. But to me, there's a short and a long-term component to this. So, I mean, do I want more single earner families? Absolutely, yes. The pain is in the transition and how we do that and how policy is going to help us do that. So, obviously I would like to see a little more policy guided directly to that. And obviously there are other episodes of the show explicitly talking about that kind of thing. So, but anyway, that's where we're at. And I think that the trends are similar for women's labor force participation as it is for men's, but just at different levels. Let's see, what else did I put in here? Okay. So here is where I wanted to do a little deeper dive into the data on by industry. And unfortunately, the data that I wanted to look at, the gross output data, has not come out for the second quarter yet. So in a future kind of, I guess, numbers episode, I will talk about that. But as a proxy, I wanted to dig into the employment data. And the thing about employment data is that we get this a lot more frequently. And so what I've done is I've taken the BLS table A14. So this is the household survey. This is where we get our unemployment numbers. And it's monthly. It's a monthly survey. So these are unemployed persons by industry and class of worker, not seasonally adjusted. So these are just the raw numbers for this index. And so table A14 is a good one, I think, for this, because we get to see this kind of industry breakout. And what I've done is I've taken April, because as we've seen here, April has been the low point for a lot of these employment statistics. So I grabbed the April 2020 data, number of employed persons and an unemployment rate by industry again. And I grabbed it for July as well. So the most recent data compared to what we hope will be the bottom in terms of a lot of this stuff. And so then what I did was I put it into this nice little table here. Let's see if I can kind of plus up the size of this thing. But anyway, let's see here. Zoom. There we go. So what I did was I just kind of grabbed that data from table A14 and I just split it out between those 2 months so we could compare. And then I computed the difference and the percentage difference. This is the unemployment rates. So in April of 2020, the total unemployment rate for people 16 and over was 14.4%. And in July, it was 10.5%. And so over that period, we had an improvement or a drop in the unemployment rate of 3.9%. If we do just a simple, 10.5 divided by 14.4 minus 1, that's 27%. So kind of final minus initial divided by initial sort of calculation. That was a 27% drop from 14.4 to 10.5. It's a little confusing because obviously these are percentages too, but whatever, just ignore that. So then we start to break this down. So this is total 14.4 and 10.5. The non-agricultural private industry, the unemployment rate was as high, was 15.6% in April, and it has dropped to 10.6 in July. So then we start to dive into the different industries here. And so what I think we're seeing is we're seeing improvement in a lot of these sectors, but we're also seeing other economic winds blowing and causing problems. So, like this first one, mining, quarrying, and oil and gas extraction, that unemployment rate has gone up from April to July. And so, again, I think this is a prime example of where we're seeing this kind of ripple effect of the retail impact of the affliction and the affliction policy, the shutdown and all of that. So, because people have stopped driving essentially, or it has slowed down so significantly that a lot of this oil and gas extraction has slowed down. And so, in April, oil and gas extraction was doing better. Now it's doing much, much, much worse. And potentially mining and quarrying, maybe there's a lot less building going on. I mean, we can see in construction, the unemployment rate shot up to 16.6%. So potentially some of that mining and quarrying is going into, cement and stuff like that. And we've seen an improvement in the construction unemployment, but it's still very high. So it's kind of the interaction between these two things. This one I think is interesting as well. Here is durable versus non-durable goods manufacturing. So this is manufacturing overall, and then a breakdown into durable and non-durable goods manufacturing. So durable goods manufacturing unemployment was shot way up in April to 15.1, and is still high at 8.4% in July. But non-durable goods, it's kind of interesting. It didn't shoot up as high. So it was only 10.2% unemployment in April, but it's still at 9. So it really hasn't improved, these non-durable goods manufacturing. So again, this is potentially this indication that, the retail thing hasn't, it's picked up. The retail itself has picked up, but the production of the goods hasn't. And so, just to speak to a couple of these different things. So in terms of non-durable goods, so, you've seen a lot of soda and water. I mean, some of these, the companies have kind of restricted the different types of soda that they're making. This is one headline I saw. And so they're kind of restricting that because they're having a hard time getting aluminum and things like that. Durable goods, my goodness, you cannot find a kid's bicycle. You can sell your bicycle for a fortune on Facebook Marketplace right now because it's just they're just not there. The friend of mine runs a car dealership in a small town, and they don't have any cars. They don't have any new cars. Their lot is almost empty of new cars because they just simply cannot get them from the from their manufacturer. Now, I think part of that is manufacturing, but I think what's also really interesting here is we're also seeing transportation unemployment is still very high and actually ticked up from April to July. It went up. So 13.5% in April and 13.8 in July. So again, we're seeing these ripple effects of the affliction shutdown. Is obviously we can these factories can produce durable goods, but if we can't get them to the retail location, then did we actually produce them? I mean, what's the point? So it's kind of interesting there. I think information as well has ticked up. So that's kind of an interesting thing to see. Seen some improvement in some of these services areas. So financial activities, professional and business services, and education and health services, those have improved in terms of unemployment, especially with, we think with health services improving as the hospitals and stuff have allowed normal things to go on. We're seeing those numbers improve in terms of unemployment, but they have not improved as much as some of these other things like the hospitality, hotels and this type of thing. That employment was absolutely horrendous in April. 39.3% is massive, and we're still at 25%. But hey, we've seen a pretty significant improvement there, even though things are just still very, very, very bad in that sector. Then we look over here at government, self-employed workers. Again, we saw them rise. We saw that unemployment rise pretty significantly, but it didn't go as high as really almost anything in the private sector. And of course, obviously, in any kind of problem like this, the financial sector is doing just fine. They, in terms of unemployment, they really didn't get hurt at all. And I imagine almost all of that was probably in the smaller financial institutions like your local bank and stuff like that. So there's my dry run on me going through some data, and I thought it would be interesting to just look at some of this stuff. I had some questions on Twitter, like one of the questions I got was why aren't we seeing inflation? With all this money printing, and I don't have a great answer for this because again, I'm not a macro guy, I'm not a money guy. Some people are calling this a win for MMT, which I think is just insane. I think MMT is nonsense, but I'm going to have a show dedicated to MMT very soon here. And my general idea with this is that we're not seeing consumer price inflation. What we're seeing is inflation in asset markets. So all of this money printing is going in to the system, and instead of showing up in the CPI or some measure of inflation, that what we normally call inflation, which is consumer price inflation, it's showing up in asset markets. So that's my view on that. I think I answered the other questions as I went through here. So feel free to leave a message on Anchor or hit me up on social media or send me an email. My email's in the show notes as well. But thanks for listening.